I'm going to break this into different segments. The first segment is going to talk about what is a fiscal impact analysis, how does it compare to an economic impact analysis. They're very different. I'll talk about the factors that influence the fiscal results. I'll talk about the use of fiscal impact analysis in not only land use planning, but also budgeting and financing examples. Also talk about an increasing trend that I'm seeing nationally of particularly planners using advocacy pieces and passing it off as analysis and what to look for in those types of products. And then finally talk about funding the gap. So a lot of times when you do a fiscal impact study, the question becomes, well, how do we use this information? And so we'll talk a little bit about some strategies that you can use to help fund the gap if the fiscal impact analysis does identify in fact, funding gaps or the fact that revenue does not cover the growth-related expenditures. A little bit about us, our firm. We're based in Maryland and Florida. We have a national practice, as you can see. We've been in business now 40 years. We've done more impact fees and more fiscal impact analyses than any firm in the country. We also do economic impact analysis and real estate and market feasibility, as well as revenue enhancement and infrastructure financing options. We've also got significant experience in Idaho, and this isn't all of it. I've thought of some more since I put this slide together. But you can see we've got some experience here locally, but also throughout the rest of the state as well. So let's talk about what a fiscal impact analysis is. The way to think about a fiscal impact analysis is the cash flow to the public sector. Okay, so we're looking at what are the costs generated by new development, what are the revenues generated by new development, what are the capital facility impacts. You put all of that together and you get a net surplus or deficit. And that is very different than an economic impact analysis. An economic impact analysis is essentially the cash flow to the private sector. So you look at things like number of persons, the number of employees, the construction phase spinoffs, what are the incomes generated, what's the expenditures on goods and services in the community, what's the indirect or spin-off or induced impacts accruing from the non-residential activity. And those economic impacts don't always follow jurisdictional boundaries. Some of those impacts may be regional, depending on the size of the project. They may have statewide or even expand into other states, depending on the type of project. And why is this important? Well, one of the reasons is that I can't tell you how many times I've been in a local government council meeting or a county commission meeting, and you see somebody from the home builders industry holding up a report that says residential growth pays for itself, or non-residential growth pays for itself, whatever the situation is. And many times, those studies are a blending of fiscal and economic information, and local government decision makers don't always understand the differences between the two. For instance, if you live in a state like Idaho, where you do not get point of sale retail sales tax, it really doesn't matter from a direct fiscal perspective what the spending is in your local community, because it doesn't trickle down directly to your fiscal bottom line. It may trickle indirectly, but you don't have a point, you don't collect sales tax locally and it stays in the community. It's the same with incomes. Obviously incomes are important from an economic perspective, but if you don't have an income tax like we do in Maryland, they do in other states, for instance Ohio has income tax by place of employment versus place of residence, all of these things have an impact on the type of revenue that accrues to a local government. So we are often asked, well, what's the difference between what you do with fiscal impact analysis and what our budget and finance people do through the annual budgeting process? And really there's two distinct differences. The first is your annual budgeting process is essentially a fiscally constrained or revenue-driven analysis. You look backwards to look at trends. You look at state funding formulas for certain funding sources like state shared revenue and other types of monies that may accrue, and then you back into the expenditures based on what you can afford. Okay? A fiscal impact analysis is very different. It is not revenue constrained. And we're making a huge assumption, which is that you are going to maintain current levels of service across the board within your community. And I can tell you that I know of no jurisdiction in the United States that maintains current levels of service across the board on an annual basis, because you walk this budgeting tightrope based on this fiscally constrained exercise. So in order to increase levels of service in one department, you're either reducing them in others or postponing growth-related capital expenditures or maintenance or rehab type expenditures in order to balance that budget. So we're going to project the costs under current levels of service, and then we're going to see if the revenues are enough. And if they are, great. If not, we have to find ways to ameliorate those deficits. So I also want to touch a little bit on market analysis because, frankly, let me take a step back, and I think I'm going to talk about this in a few slides forward. First of all, very few communities actually do fiscal impact analysis. And I would guess that probably less than 10% of jurisdictions in the country actually include fiscal analysis as part of their land use planning efforts. Now, most planning acts require you to address public facilities or capital improvement elements, or what some states define them as, but that's only part of the equation. That's only usually 15 to 25% of your total budget. It's the operating costs that make up the largest share of the budget. And so most land use planning exercises talk about sustainability, but they don't talk about fiscal sustainability. And so there is no fiscal component in those plans. But even less so than fiscal analysis, market analysis is not performed. And I think that's critical because we work with a lot of clients nationally where, for instance, like in one jurisdiction in particular, Queen Creek, Arizona, which was featured in this article in the Wall Street Journal a few years ago, where they were banking all of this land for retail sales, and the development community was trying to pressure them to rezone it to residential. And the reason they were banking this land for retail is because retail is king in Arizona. Okay? Most of the jurisdictions get sales tax. They don't understand their market position. They are never going to get the shopper's goods because other communities are more competitively located in order to capture that market. And so the real key for them, and the idea behind this article, it also featured another client of ours in Louisville, Colorado, which was in the same boat, is that if you increase density, and we know density is a bad word in a lot of communities, right? But if you increase density and in mixed-use nodes, it supports an organic retail model, and if you understand that you're not going to get the Lowe's and the Home Depots and the Best Buys of the world, but you still need to increase your sales tax base, you can do it organically through mixed use and density because it generates the need for supported types of retail. And so the reason I put this market analysis slide in here is we're seeing more and more jurisdictions get interested in knowing their position within the market. Okay, and so they want to know the highest and best use for different parts of the city. They want to know if there's unmet demand for certain projects, who are their competitors for supply of land, and that largely varies from state to state based on the revenue structure. Some places are emphasizing industrial land versus retail. For project-specific analyses, they're wanting a market component to look at the sales and leasing projections, looking on return on investment, and also incentive analyses, which we'll talk about a little bit later in the presentation. So, what kind of questions can you answer with fiscal analysis? Well, these are the lists I've put here are just sort of the types of analyses we do on a day-to-day basis. First one is pretty standard in the planning world, is you want to understand the relationship between development densities and infrastructure costs. And I'm going to talk a little bit more about that as we go on. What's the relationship between property tax and density? What's the return on government investment? What's the optimal mix of land uses? What's the relationship between geography? Because there can be huge cost differences based on geography. Particularly with the way we do analyses, we focus on marginal costing versus average costing, and the difference is, for instance, with fire, an average cost analysis is going to say, well, it's $37 per person a job to serve you for fire. Well, that's not how fire is provided. Fire is based on your station locations, what their call capacities are, what the traffic patterns are in the area, and so depending on the conditions or excess or lack thereof of capacity, you can absorb a lot of development with little or no cost, or the next project could trigger the need for a whole new station. And so the cost could be very different in different geographic areas of your community. And the biggest question we could ask is the serious one, which is, are we in what we, a vicious cycle of having to grow in order to finance our operations? So we have this addiction to growth, also referred to as the Multeri curve in California. So when we incorporate market analysis, it can lend a sense of reality to the analysis, because otherwise what you end up doing is just brainstorming scenarios, what-if scenarios. What if absorption is faster or slower? What if the mix of uses is different? Different assumptions for retail sales per square foot, or different assumptions for property tax rates, et cetera. And so without that market analysis, it's almost like a guessing game. If the budget doesn't include the money for a market analysis, you have to rely on these scenarios that you brainstorm. Market analysis also provides context. What are the region's competitive advantages? Where will employment growth likely locate in your community? And there's been a big paradigm shift over the last 15 to 20 years where it used to be the company located where the CEO lived, and now companies are locating where the employees want to live, which is why you're seeing very progressive places land a lot of high-tech and maker spaces and software development type gigs, because people want to live in vibrant places that have a lot to offer. Are jobs shifting from urban areas to the suburbs or vice versa? That depends on the region you're in. And the big one that we're seeing is, what are these changing demographics and lifestyle choices affecting jurisdictions from a market perspective? And it's, over the last 10 years, we've seen this shift of where you basically see millennials and retirees or empty nesters wanting to live in the exact same place. When do you remember that happening in your lifetime? And that's why we've seen this huge. Do you have a question?
Yeah. When did that happen?
What's that?
When did that trend come about that they decided to put businesses where people want to live as opposed to where?
That's been over the last 10, 15 years. Yeah.
Which, I guess what
Yeah, it's the rise of the creative class. If you remember that book in Richard Florida's work, he's well documented that type of stuff. And why should we care? Well, one, as we've transitioned from slow economic recovery to normalized growth, and now there's actually signs from the National League of Cities survey on fiscal health that we've sort of peaked in 2015 in terms of revenue growth, and there's some signs that maybe there'll be a slowdown here in the next year or two in terms of local government finances. And we'll talk more about that tomorrow in our workshop session. But because of these slowdowns, jurisdictions want to understand the impacts of sort of a boom-bust cycle, what happens under, if we go into a recession or it retards our property tax base, et cetera. They want to know that we're seeing more and more local governments, as they exited the recession, start to act more like businesses and ask questions like, using terms like return on investment. We never heard return on investment prior to the recession. Now we hear it all the time. And we're being asked to evaluate incentives more than ever, because as people came out of the recession, a lot of developers saw that jurisdictions were desperate for revenue, and so they would get quite brazen in their asks, if you will, for incentives. And the jurisdictions, a lot of them rightly so, asked the right questions and did fiscal and economic analysis to understand what that meant to them in terms of their payback period on their investment. And then also, why should you care here in Idaho? Well, you have a property tax cap, and you're one of the few states that does. And so, as you continue to grow, how does that impact your fiscal bottom line, given the property tax limitations that you have? Now, in terms of fiscal analysis and practice, I've already touched on the first one, that most local governments really don't know what the fiscal impacts are of their land use decisions and their project-by-project decisions. Rarely required, gaining in popularity, as I mentioned, since the recession. So we're asked, well, why isn't fiscal analysis used more and more? Well, fiscal analysis is an art and a science, right? It's not like calculating stormwater runoff, which is the same equation. You just plug in numbers and you get your result. For fiscal analysis, the analyst has a lot of leeway in terms of the methodology they employ. I've already mentioned too, average costing versus marginal costing. You'll get drastically different answers. Now, at the end of the day, over the cumulative time period, the actual revenue versus expenditure may be 5 to 10% from each other, but what gets lost is what happens in years 1 through 20. Are you going to have to subsidize a project for 10 years before you get your return? The average cost isn't going to tell you that. It's just going to just stair step it up like this, where the marginal costing is going to show you the ebb and flow of revenues versus cost. There's also a method called comparable city, where you basically say, for instance, Meridian is comparable to city A in California, so we're going to use their cost structure. And you can see the fallacy in that. But you have considerable variations in methodologies. You can make all sorts of assumptions in the analysis, so it's very important that you publish these assumptions so you're not accused of having a black box. Cumulative impacts aren't tracked. You sort of look at development projects in a vacuum on a case-by-case basis, and then lose sight of the fact that by approving all of these, what's the impact? And in most cases, the fiscal analyses aren't prepared by the local government. They're prepared on behalf of the developer. Okay, so it's not surprising that most of them say that they're positive. I've seen very few that show that they're negative. And it's kind of refreshing when you do. But you need to understand those cumulative impacts. Also, costs can change over time. And that's another reason we use marginal costing. For instance, the example I like to use the most is Parks and Rec. The traditional model for Parks and Recreation was to build community parks, neighborhood parks, regional parks. Well, most parks departments have gotten out of the neighborhood park business, and they're really getting out of the community park business. Really what they're focusing on now are special purpose parks, athletic complexes, and spray parks and aquatics facilities. And those types of facilities that you're going to build in the future can have a very different cost per acre to maintain in the future than using the cost to maintain your traditional facilities that you've maintained in the past. And we can also say the same thing with transportation, because a lot of communities we're working with around the country are, this focus has shifted from moving cars to moving people. And so there's more multimodal type improvements being built, and they have a very different operating cost than sort of the traditional lane mile capacity. Most analyses also don't do a good job at reflecting geographic differences. They're sort of homogenous by your community, but even looking at Meridian, you can see differences in development patterns. And so what we like to do is tailor the models that we develop to show that, for instance, in a downtown situation, you're going to have a very different style of retail, you're going to have a very different style of residential development than your more auto-dependent strip centers. They have different trip rates, different employment densities. They're probably going to have different sales per square foot factors if we were in a sales tax state, and that was going to be modeled. And so you want to be able to tailor those model or those specific geographic areas into your model. Now let's move on to factors that influence the analysis, which is always my favorite part. Now, how many people believe this is true? That residential development doesn't pay for itself, and non-residential always generates surpluses? No takers? Okay, good. Exactly. I run into this on a weekly basis. Okay, so this is what influences the factors for a fiscal impact analysis. The first one is the most important, and that's the revenue structure. What are the sources, and more importantly, what are the distribution formulas? We've already mentioned that sales tax varies from state to state. Sometimes it's collected at point of sale. Sometimes it goes to the state and is distributed. Some states have income tax. Some states have multiple. Like in Maryland, where I live, we have the most progressive revenue structure in the country. And sprawl, we've showed time after time, sprawl pays for itself because all the jurisdictions collect property tax, they collect income tax, they collect impact fees, they collect transfer taxes, and in most of Maryland, the housing is expensive, so by definition, the property tax is going to be higher than the national average. The incomes are higher than the national average, so all these jurisdictions are flush with cash. And the transfer tax, I remember when I moved to Maryland from Richmond, Virginia in the early 90s, and yeah, so I was a young kid with not a lot of money, And 5% down payment was the least of my worries because the transfer tax was going to be 7% of the house. So you can imagine that's a huge one-time revenue that the local governments get. So revenue structure plays a huge role. Levels of service in the community. And what we mean by that, and that and the infrastructure life cycle sort of play hand in hand. And that has a lot to do with where the community is in its lifespan. Are you still a rapidly growing greenfield type city? Are you one of the first ring suburbs in an urban area? Are you a redeveloping city? All of that plays a role. For instance, we did work at the same time in Lawrence, Kansas and Lenexa, Kansas. And we showed that growth paid for itself in Lenexa and it didn't in Lawrence. And a lot of it had to do with the infrastructure life cycle. Lenexa was an older city. Its infrastructure footprint was largely developed, so it could absorb substantial development without a huge outlay for infrastructure. Whereas Lawrence, rapidly growing on the fringes, constantly spreading or continuing to build infrastructure, and so that was very costly. And so you got two different answers to the same question there. And finally, the characteristics of development. What are the characteristics like persons per household, vehicles available, so that affects the trip generation rates, incomes, property taxes, spending patterns, all of this, school-age children, if your local government is responsible for providing the schools, because not every state has taxing school districts, some of them are just part of the county government. And so all of that plays into the analysis. So I'm going to show you some examples here. And this is from my colleague and good friend Bob Rochelle, called the Fiscal Hierarchy of Land Uses. That was in his seminal publication, the Fiscal Impact Handbook. But basically it showed that, in general, that most of your residential uses don't pay for themselves, and most of your non-residential do relative to the municipality versus the school district. But as you're going to see, these are not hard and fast rules. So this shows non-residential development. We call them prototypes. In Scottsdale, Arizona, which, as I've said several times, so local governments or cities rely heavily on sales tax. If they have a property tax, it's very minor. It usually goes to debt service. But because it's point of sale, meaning every new retail square foot generates income, your resort and retail uses generate huge surpluses per 1,000 square foot, and office and industrial basically are a wash, or modest surpluses at best. But you take those same generalized uses and locate them in Ohio, and you get a completely different answer. Because in Ohio, the local governments get income tax by place of employment. So if you live in Columbus, but work in Dublin, Dublin gets your income tax. And so you can see here it's just the opposite. Retail, because of the low wage jobs, generates substantial deficits because everybody forgets the cost of retail, or the cost to serve retail is high because of the public safety cost and the transportation related costs. And so if you're not getting that sales tax revenue, a lot of times it's a dog fiscally. Office and industrial and R&D generate huge surpluses because of the high wage employment. And in Idaho, these same principles are the same, but you have these conditions that are very different here in Idaho. As I mentioned, you're basically a property tax state, but you have this 3% limitation, and up to 50% of a home can be exempt, which I think it may be the largest in the country. I think most places give you an exemption of about 25%, if I recall. Sales tax is distributed as part of state shared revenue. It's not based on point of sale. And like most local governments around the country, you then rely on charges for service, which could be things like sales of maps or police records or parks and rec fees, that kind of thing. And then your franchise taxes and that sort of thing. So you really only have one real growth-related revenue source. So you can already see that in Idaho, you have a challenging fiscal situation because a lot of states, believe it or not, have two growth-related revenue sources, whether it's sales tax and property tax combined, or excuse me, income tax or property tax or sales tax. It could be any combination thereof. But you are somewhat limited compared to other states. So this one points out the influence of demographic characteristics, which are very important. And this is just within residential, okay? This was a study we did in Sarasota County, and we had, and this is in Florida, where we had geocoded data for school students because the counties provide schools. Okay, that's part of your tax base there, or your tax rate there. But you can see here that in Bel Air Estates, these were large lot subdivision. They generated no school children in Sarasota County schools, which is the main reason for the surplus. But they were also empty nesters, most of the folks that lived there. High property tax because they were large lot, high value homes. But as you move to Greenfield and Summerwood, which were entry level and sort of mid-level subdivisions, these subdivisions generated substantial amounts of public school students, and they have sort of average to slightly above average assessed values relative to the county, and so the property tax revenue isn't as high. And so you can see here, just 2 single-family subdivisions or 3 single-family subdivisions generate different fiscal results, and it has to do with those demographic and socioeconomic characteristics of land uses. And I've touched on this already. A lot of jurisdictions provide different services. Sometimes schools are included, but a lot of times what gets lost in the minutia is that one community may be the winner fiscally, but another community may be the loser because the school district's going to have to educate the kids, or one community is getting all of the housing, the other community is getting the employment. So it's important that we keep this in context. Now, personally, I don't like doing these types of studies. We call them cost of land use studies, where we define these discrete prototypes versus looking at scenarios in total. And the reason why I don't like doing them is because what happens is a lot of times elected officials, they hone in on particular land uses. And the tendency is to then start practicing what we call fiscal zoning, meaning that every project has to pay for itself, right? Or we're only going to encourage this land use. And really, the point of these studies is missed, and that is that you have to understand how all these different land uses impact you based on your revenue structure in your community, but knowing that, and second, knowing where you stand in the market, okay? The idea is to get the right mix so that you know that if you get three projects that are losers fiscally, you're not worried about it because overall your 20-year game plan is solid fiscally. Because every community has contributors and recipients, right? It's just the difference between who's the contributor and who's the recipient varies from state to state, right? It's not development's fault that it doesn't pay for itself. It's the revenue structure. And so the importance is to understand this balance and get the balance right going forward. And this just shows you what I mentioned earlier, the infrastructure life cycle example from Lenexa. We looked at 4 different scenarios here, and the takeaway here is, I think this has the takeaway here is we're looking at the operating budget and the capital budget. The good news is they're generating operating surplus. And why is that good news? Because the operating budget is funded by your primary growth-related revenue source, okay? Capital deficits are always, I shouldn't say always, but relatively easy to fix. If you have operating deficits, that means you have fiscal structural problems. There are ways to solve for the capital deficit through special assessment districts, impact fees, all sorts of other things, okay? So that's the takeaway from that slide there. That was Lawrence, where I told you the growth wouldn't pay for itself. So let's talk about, and I've already sort of gone through some of this, the types of fiscal analyses that you'll see. The first one I mentioned, cost of land use. You've seen some examples of those. Most fiscal analyses are actually done on projects. As I mentioned, most of them are prepared by the developers. There are some jurisdictions that do have their own fiscal models. Like we develop models for jurisdictions that they use to evaluate projects so that it's a consistent analysis. Because if you're making it incumbent upon the developers probably has 20 different locals that they use to do these. Sometimes they're accounting firms, sometimes they're planning firms, and so you get this wide variety of